So, Patrick, perhaps you could start by telling us a bit about you and a bit about your story, really, what you do and where you've come from.
Sure. Well, thanks. My name is Patrick Rush. I live in Greensboro, North Carolina. Originally from Chicago, Illinois, and been in the financial markets industry for about 23 years now. Started kind of worked in all different channels of the financial market industry, from the Chicago Board of Trade, Chicago Mercantile Exchange, the old Smith Barney and the Sears Tower. And so I've been in the wirehouse world, I've been in the bank world, and as well as independent broker dealer. Now I am a fee only financial advisor in Greensboro, North Carolina.
And you've written a book, so perhaps tell us a bit about the book and what the motivation was for putting pen to paper.
Yeah. So I think, I always feel like I got a lot to say. There's so many things I feel like I've experienced in the industry, good and bad. I would say a lot more good than bad, but I felt like it was time to put some of this on paper, and some of the things, how my career has evolved, some of the things that I've learned and things that have become more important to me. Because I think most of the time people think about investing and financial advisors that it's all about the money, right? It's all about getting the best returns and so forth. And as my career has evolved, as my life has evolved, I've realized that there's a lot more to it than just that. So the financial planning, the giving back to the community and being involved in your community, trying to really make a difference and leave the world a better place than you came into it, meant a lot more to me than just the stocks and bonds and mutual funds and so forth. So I put pen to paper and started writing this book to try to give a little insight into my story, what I've learned in the markets, again, some of the good and bad. Talk about an evidence-based investing philosophy that works over time to give people the highest probability of success as investors. And then what that money is really going to mean to you, trying to figure that out, and then how you might want to do it in a more tax efficient way if you're interested in giving back to the community and nonprofits that you're passionate about. How can we do that in the most tax efficient way?
There's a fair bit to unpick there, so if I may ask a few questions off the back of those points. But how have you seen things change over time? I know, thinking about our parents' generation and those, I guess, who grew up following the Second World War, that baby boomer generation, they probably had a very different attitude towards money and building wealth than what we so often see today. I mean, in recent months, seeing the rise of day trading applications and people trying to get rich quickly. I know get rich quick has always been a thing, but it seems to be more prevalent these days than it possibly was back for that parents' generation. So, what changes have you seen?
Yeah, I mean, I think that's a great point. When I first got in this business, it was still kind of at that point where people worked for the same company for 30, 40 years. They got the gold watch and the pension, and they retired and had kind of a pretty normal retirement and maybe died 10, 12 years later, right? Because they worked till they were 65, 68 years old. They had Medicare, they had their pension. I think people are a lot more transient now. They change jobs a lot more quickly. The investing world is not so much about stock picking. When I first got in it, I still remember, I mean, it was kind of interesting because we were in a tech bubble, right? In the late 90s, everybody's just buying stocks. They think making money is easy. They're doing all the day trading. And we realized that fizzled out very quickly, and we saw the tech bubble crash. Now, though, I think people are thinking more of investing in their 401ks. We don't have pensions like our parents may have. So now the responsibility is on you to save for your retirement, to be prepared, to make better financial decisions, to ensure that that you're going to have enough retirement savings. I think people, especially those of wealth, are living longer, healthier lives. So they need to be prepared to make that money last for 20, 30 years, as opposed to just maybe another decade after they stepped away from their job. So, and then within the industry, I mean, there's just been tremendous changes in my opinion. It used to be a lot more of the wild west of stock picking, and a lot of stock jockeys out there just trying to think that they can outwit the market all the time. Now it's a more, slow and steady wins the race, buying very passively managed funds, index funds, and just kind of grind it out, dollar cost averaging into your 401k. I see a lot more of that, which is good for the most part than the days of just going and trying to outwit the market.
I think there's lots of parallels between the development of the profession, the investing profession in the US and the UK, and we've certainly seen that shift towards professionalism. You mentioned being a fee-only financial advisor. That's certainly the model that we're all we have to follow here in the UK. There is no alternative. We have to charge fees and higher qualifications and things. But you mentioned more transient lifestyles, and I guess this is not having a job for life anymore. This is not leaving college and going to join your employer and then retiring 40 years later and receiving that big pension. So is this all about taking greater personal responsibility for wealth and looking after yourself a lot more?
Definitely. I mean, but I think there's also a part of it that is those that kind of instant gratification, right? Like everybody, a lot of times you're jumping job to job because you're searching for something better all the time. The grass is always greener. So you end up, spending 3 to 5 years in a career and then trying to move up and move up and move up. Or maybe it's just staying in place or staying in the same job description, but maybe your new job is going to give you more work-life balance.
Yeah.
But the days of somebody staying and being loyal to a company, and I don't want to use that word loyal like in a bad sense, but it's I feel like that those days are just not the same. People want more from their employer and their life.
And all of this obviously has consequences for our financial planning. These are things we have to factor into our financial plans, to ensure that we have the resources, the wealth that we need to get us through life's journey. Patrick, you mentioned charity and supporting maybe local causes or other charitable causes that we're passionate about. How does that factor into the work you do and into people's overall financial planning?
Yeah, so I mean, that's been a big thing, not only with clients, but myself personally. And I think what we've found out is those that have means, once they realize that they're not going to spend all this money, they want to start doing some good with it, right? They want to give back to their college or university. They want to be able to give back to some organization that means a lot to them, whether that's dogs or the Red Cross or the March of Dimes or whatever it is that they're passionate about. They want to do something. And we've seen a lot of people give to their church during their working years, and they do their tithing. Well, why should that stop in retirement, right? Why should all of a sudden, because your income stops, should that stop? We need to find a way, a tax efficient way to do that throughout retirement. So those are some of the things that we've been able to do with clients, figure out the most tax efficient way to continue that giving strategy for the rest of your life. And maybe we can now increase it. Maybe because you've had sufficient savings, and let's face it, we've seen a stock market that's just gone in the US has been incredible for the last 12 years now. And people are they have more money for retirement than they expected in a lot of ways, for many people. I'm making generalizations, but for many of the clients that I work with, they're in much better shape than they expected to be, especially after 2008, 2009. They thought they'd be working well into their 70s just to recover. And now they're looking with ample savings and saying, hey, my kids are in good shape, hopefully, and they're not going to need all of this money. So what else can I do to be able to provide, a legacy to my community?
How can we do that with confidence though? Because it's a very scary thing, I know, for a lot of people to, to dip into the bank account or the investment account and give money away and completely lose control of that money. Once it's gone, it's gone. So what steps do people need to think about to make charitable donations with a higher degree of confidence that they won't then run out of money during their own lifetime?
Yeah, it's a great question. I mean, and that's why you need a financial plan, right? That's why you put those numbers and you stress test probabilities of success through Monte Carlo simulations and so forth. And you say, you try to pick a number and say, all right, is 5,000 going to work for you? Is 10,000 going to work for you? 20,000, whatever it is. And let's stress test this in a Monte Carlo simulation with 1,000 different trials and see what is the probability that I can continue to do this throughout my life expectancy. And we generally use a more conservative life expectancy, meaning we'll run it out until age 96 or so, because there is about a 25% chance that a healthy 65-year-old couple, at least one of them, will live until age 96. So we want to run that out a little bit longer. And then once you see those results, I think you can feel a little bit more confident that you're not going to run out of money.
Yeah.
And if there comes into some, hard times where maybe the markets don't do well for significant periods of time, well, then we can scale that back. We got different levers to pull. Most times people are not going to sacrifice their lifestyle, but we can maybe pull back on some of the charitable giving. But again, proper planning, you should be able to make this work.
And then, to what extent do we need to involve family members in those conversations? Because I guess there's an expectation of an inheritance for lots of children, adult children, who are looking at their parents' lifestyle, their parents' perceived level of wealth, and they're expecting to receive the lion's share of that at some point. And if they suddenly see a giving strategy being implemented, that may be quite unsettling if it's happened without a conversation.
Yeah, I mean, those are always some fun conversations to have when you start dealing with expectations of children, right? Because we try to get involved in some of these family meetings and have some of the discussions, but sometimes it's not about discussing numbers. It's about just discussing with the children that mom and dad are going to be okay, right? They got enough money. They're going to be in good shape. They're going to live the lifestyle they want to live. And anything left over is for you. But a lot of times parents don't want that money, the actual number discussed, because it is all, it could change dramatically over the course of 20, 30, 40 years. So let's not necessarily bring that in, but it is interesting to me. We've had some children be like, when we've looked at mom and dad's budget and how much money they want to spend, as opposed to talking about portfolio values, the children will start saying like, wow, mom and dad, you're spending a lot of money, and you're thinking like, they're spending some of my inheritance here. It's like, well, that's not your job to tell them how they should live. They've worked for this. They've worked their butts off. And I always, try to tell people, for parents, the best gift that you can give to your children is really just letting them know that you're going to be okay, that they are not going to need to step in and take care of you financially. That's the best gift. Then you get into things like college education and being able to provide for that. But first and foremost, it should be about mom and dad being accountable for themselves, and they're going to be able to take care of themselves financially without needing their children to step in.
It's funny how that's a two-way thing, isn't it? Because the children may be concerned the parents are spending their inheritance, but actually the children should also probably be concerned that the parents will run out of money and then need additional financial support to help pay for care to get
That's
them through
right.
that later stage of retirement.
I mean, we see that all the time, right? I mean, that's called the sandwich generation, right? And that's something I'm dealing with myself. I got three young children, aging parents, and they're needing help. And I'm also obviously raising my children. So you're caught in the middle between more elderly parents and young children. That's hard. You know, that is really can be really stressful on on the individuals, all of them, right? Because my parents don't want to rely on their youngest son to take care of them financially. It can be tough on a marriage too, right? Because your spouse could be looking at you saying, hey, my parents don't need help. Why are you helping yours? Because that's just taking resources out of our family. So it's difficult.
Yeah, so there's questions of fairness and equality come into that when you're in a relationship and things. All of this, I guess, done well, relies on having the right advisors around you and the ability to build that plan and to consider lots of different scenarios. So, for somebody listening to this conversation or watching us having this conversation, Patrick, what would you say to them about finding the right advisor for them?
Mm. Yeah, I mean, it's great that you guys have it in the UK where you got to be fee only and so forth. I mean, that's a big part of it, just because it reduces the conflicts of interest. Um, that's the big part. It's not to say there's not good advisors elsewhere who are receive commissions and so forth. They're everywhere. I know a lot of good people. I've worked with a lot of good people. But at the end of the day, and unless you're legally obligated to act as a fiduciary for your client, there's a lot of different things that can happen there. But I also think the education. I mean, I don't understand in the U.S. how it's not a mandate to have something like a CFP. I mean, the CFP, is the gold standard in our industry, and you have to put the work in to get that certification. You wouldn't go to an attorney if they didn't go to law school and pass the bar. You wouldn't get a CPA or an accountant if they didn't have a CPA. You wouldn't go see a physician if they hadn't gone to medical school. But yet in our business, where you're managing millions of dollars, but billions of dollars in a lot of cases, but more importantly, people's life savings. Yeah. And there's no barriers to entry in our business. That is, there's something really wrong with that. And I think that was one of the triggers why I wrote the book too. Because I really think there needs to be, more transparency in what's going on. But in searching for an advisor, I think, certifications, I think the fee only, I think experience is big. And there, I don't want to sell myself too much here, but I think there is a difference between, somebody coming right out of school who's got the certifications and the qualifications. They may be super sharp, a great practitioner from the book sense. But if you haven't had some of those life experiences, it's really hard to give prudent advice to people who are going through serious life transitions, right? I mean, and there's a lot of things that people say, investing is easy, just buy and hold, forget about it, all this stuff. I'm not going to worry about it. That's fine until you go through some serious life events. That changes everything, right? You have a disability, you have a death in the family, you have a divorce, you have, something like that happens and it just rocks your world. And now it's those unexpected things that are the most damaging to anybody's financial plan. And so in my opinion, I mean, I think that's where you have to have a good blend of those certifications, but also experience. And then at the top end, I think there's some folks that stay in this business too long, right?
Mm.
Where they're no longer learning. They're just kind of hanging on, and they continue to do it, and they don't. They're not necessarily trying to take their game to the next level.
Yeah. I guess that goes back to your point about relevance experience. It can't be the same year of experience repeated year after year. It has to be fresh experience, but keeps you up to date, that keeps you developing yourself as time goes on.
That's right. That's right.
Patrick, thank you so much for joining us on the Informed Choice Radio podcast today. Before I let you go, how can we find out more about the book and how can we find out about you and get in touch if we want to?
Yeah, patrickrushtfa.com, and there's also triadfa.com. You can learn more about me and my firm, Triad Financial Advisors. But I really appreciate the time to be here and the opportunity to meet with you. You do a great job. Keep up the great work.
Thank you very much. Take care.
All right. We'll see you.